So AI is real, but on the other side, valuation is way too high.
Hello, everyone, and welcome back to the Data Minute Podcast. I'm your host, Peter Walker, here at Carta. Today, I was privileged to speak with Lu Zhang of Fusion Fund. She's one of the most interesting emerging managers that I've ever spoken to. She's actually on Fund 4 of Fusion Fund that just raised an oversubscribed $190 million Fund 4. In this environment, that's pretty impressive. We talked about, obviously, the successful raise of Fusion Fund 4. We talked about what many GPs get wrong when they're talking to institutional LPs. We spoke a little bit about building new LP connections with Starlink while you're in Antarctica with the penguins. And then, of course, we wrapped up by discussing AI revenue and the advantage of showing those LPs the actual portfolio metrics for your underlying companies instead of just relying on fund benchmarks like IRR and DVPI. For the founders listening in, don't worry, we touched on a ton of topics you're going to love too, including the founder willingness to tackle regulated industries and why Lu believes that this AI revenue moment is here to stay, and you're probably going to need to move even faster than you're thinking about moving right now. Let's jump into the conversation. Lu, thank you so much for being here. I really appreciate the time.
Yeah, thank you for having me.
Absolutely. What did you think of our little studio before we get started?
Oh, it's very cozy and also very professional.
Thank you.
Really, glad to be here.
Absolutely. Yeah, we used to do this in the office, but I think it's much better with this professional studio we have. I have a ton of questions for you, but actually we're just talking about something pretty interesting off mic, which is the quality of founders that you're seeing at Fusion Fund.
Yeah.
Can we just talk about how that's changed over, say, from 2022 to where we are right now?
Yeah, so I think one thing is also related to the sector we've been focusing on. As you know, we do enterprise AI, healthcare, and industry automation.
Yep.
All the company we're investing in, their business model is B2B. So naturally, most of the founder we are investing, they have experience in the industry. So experience the founder, and lots of them are repeating successful founder. Yep. So something we're seeing interesting shifting from 3-5 years ago till now is there's more repeating founder coming back to the game. So we're joking that because I was a serial entrepreneur and also have lots of former entrepreneur in my team, we're like, okay, all these founder, they got financial freedom already.
Right.
And they know how miserable the founder life was. Why they decided to jump back to this miserable life, giving up their beach life and casual life is because the opportunity is big enough. So when we compare the ratio, for example, our Fund 1, Fund 2, roughly 30-40% of the founder background are repeating successful founder. Fund 3 is actually 70%, 70. Yeah, we didn't intentionally try to pay for one versus another.
Sure.
It's just the result of the selection. Yeah. I think that's also a strong indication of the market trend. Another thing is go back to the bigger trend right now here with AI. And in terms of enterprise level B2B AI, how to do corporate sales. That's even more important than whether you have a super fancy AI solution.
Yep.
Another thing is access to high quality data in order to train your model in a smaller size with lower cost. So that I'll go back to which type of founder probably have a relatively easier start in the market.
Do you think that those founders who kind of feel the itch to get back into the founder game after they've already done something successful, do you think that because they are already successful, it kind of allows them to go bigger? Because they're not as worried about, more sort of mundane concerns. They're just trying to hit the biggest possible opportunity they can.
I think that will be one definitely advantages for the repeating founder.
Yep.
But I think more importantly is because they went through the journey in the past. They actually are really focusing on the fundamental of the business, which is the revenue.
Yep.
The market right now, yes, is a great trend, but also lots of capital. There's some bubble on the valuation.
Yeah.
So whether it's the illusion of the valuation matters more or just a solid foundation of the revenue, profitability of the product matters more. I think for repeating founder, they probably have more experience understanding long term, which is better for them and also for the company. Another thing is also we're looking at, okay, if it's an application-focused AI company, probably this repeating founder have lots of the strong edge. And also look at some interesting AI infrastructure company. That's when relative young founder, first-time founder also coming with a strong edge because they have a new idea. They are now thinking within the box.
But different edges.
Yeah, different edges. And also they are thinking about how to have the new architecture, be able to create an AI infrastructure company and just fundamentally make AI cheaper, how to make AI affordable. So we're seeing very diverse and dynamic founder community right now.
So you touched on two things that I wanted to get to. The first is, are we in a bubble in terms of valuations? What are your thoughts there?
I think so.
Okay.
I think we need to separate two things. AI is real. It's huge. It's kind of enabler. AI is not only just to supercharge the industry digital transformation across industry. AI is also supercharge other technology because we also invest in healthcare.
Right.
Healthcare is a huge market, big problem, but how painful it is. We all kind of experience it. Now with AI, there are so many new things came out. It's a big accelerator. So AI is real, but on the other side, valuation is way too high. And we have to think about essentially where is the profitability, what is the margin, and also whether industry are able to afford it. AI be affordable. Our ROI of the AI technology is the most popular topic right now for the large corporate to really discuss internally. But on the other side, if we have the right solution, they have tons of data, huge amount of high quality data to show the capability of AI. So I think we need to be really kind of thinking through where are the right opportunity vertical AI to invest, and also what is the proper price to buy in.
How do you convince or negotiate with a founder around that proper price idea? I'm sure that many of them walk in with elevated expectations.
Yeah, of course. I think on one side, it's just a different choice. I'm not saying that, we have our own opinion, other people have other opinions, whether there's more investor talk about there will be more like $1 trillion company in the future. So if it's $1 trillion exit,
entry price doesn't matter as much.
Doesn't matter. But for us, we really think there's also opportunity. I think it's more likely it will be opportunity with hundreds of $5-10 billion size of the company. It's just the number of this type of a super unicorn going to be much more, much bigger, versus the couple single one going to become $1 trillion. So just a different projection of the market. And also based on that, if you really look at the valuation, we choose to be disciplined. We choose to be disciplined at the early stage. We're mainly doing seed, pre-seed, and Series A.
Right.
And we want to make sure the price makes sense long-term in terms of return multiple. And also in the proper range that the founder would really think logically about how much money they need to raise. Sometimes have too much capital might not be a good thing to start. I always tell the team saying that, okay, when do you think a smart people are going to make a stupid decision? Most likely it's because you have too much capital. When you have limited resources, limited is really nice word. You're going to be so focused on how to make every penny worth. And that's when you make smarter decision. So sometimes the nature of early stage venture require limited resources and capital in order to continue to get market validation, pivot, and eventually have the right product market fit. So when we talk to founder, another thing we have is not only we're a group of technologists and the former entrepreneur. I did establish the robust network called the CXO network since 2018. And me and my partner Shane, we co-lead it. Shane was the former CTO of HP. So within network, we have 45 CTO from Global 1000 companies. And leverage this network and also their CTO. Why CTO? CTO have technical background. And CTO, lots of them are former entrepreneur. They're the one champion internally, asks for digital transformation push, asks for bigger budget from the board to give contract partnership to the founder. So we'll work closely with them, knowing what they're looking for and knowing how much budget in which vertical, then we'll be able to quickly introduce the customer and also contract to our portfolio company. This network already bringing total over $150 million worth of the revenue and the partnership to our founder. And that's how I persuade founder. I'm like, working with us, instead of raising 10, probably raising 5. And then we could bring $3 to $5 million contract.
And commercial contracts.
Yeah, so, exactly. You still have 10, but only 5 million are diluted. Which
revenue,
one is better?
Revenue is the best capital you can raise.
Yes, and then we can talk about valuation. We'll be more reasonable.
Sure. Right. It's a little bit more disciplined that way. That was something that I was going to bring up later, was that when I was kind of fit Fusion Fund into this broader network of why you stand out amongst venture capital, the multiple sort of deal access points you have through these networks that you built really did stand out, where it's not just the CXO network, but it's also the fellowship on the VC side. It's also like the way that you've connected these founders. And I hear this increasingly from a lot of fund managers where just providing capital isn't enough, right? You need to have a network advantage. And it seems as though you've really found a great sweet spot. So like, what can other emerging managers or GPs take from that sort of strategy, you think?
Yeah, I think especially for emerging fund manager, I think number one thing is really focus on the founder community. Essentially, early stage is about the sourcing. And you in Silicon Valley so long, actually the best founder got to pick whose money to take, right? It's never only about the capital. It's about the alignment, the vision, and also the value creation as an early stage partner. And also early stage, it's a very vulnerable stage. for any startup, and the company will go up and down, and how to understand the life cycle. I think just trying to think from that angle to build up your edge and advantages is very important.
Yeah.
For example, the first network I built up was now the CXO network. The first network I built up in 2015 is our super founder network.
Right.
Funny story, at that time, initially I was an entrepreneur, so I also went through the fundraising journey, not super successful. So that's the reason I have a group of founder friends. We get together, complain about, VC so stupid, we don't like them.
Right.
And when you're talking shit about others, you become very close friends very quickly.
Sure.
And later I started a Fusion Fund as a solo GP. They're like, you went to dark side. You sounds like a shark now.
No, but you're gonna bring light to this dark side.
Yeah.
You're gonna be one of the good ones.
Exactly. I told them that don't call me shark. Shark has very small brain. They're not even smart.
Right.
And if I'm gonna be a predator, I'd rather to be a dolphin.
Smarter
one, and also dolphin work as a group and a community come working with me. So we start to build up this super founder network with all repeating founder, experienced founder with exit minimum $100 million or more.
Wow.
Gradually build up now is 62 members in total. But this is the initial channel for us to source deal. Another thing is when a successful founder tell another founder that you should work with Lu and Fusion Fund, they're top notch.
Yeah.
The reputation and also credibility is really high.
Yep.
That's how we initially build up the traction in Fund 1, Fund 2. Of course, now we're in Fund 4. There's a track record, their community. We've been in the market for 10 years. But the first initial couple years really need to think about creative approach to stand out. It's a very competitive market.
It really is. And it seems you touched on one of the most interesting things there, which is the referral network from founders themselves back to VCs like yourself. How do you handle a situation in which that referral can be really tense, i.e., one of your investments isn't doing well or it needs to shut down, or you think that you disagree with the founder about maybe a strategic acquisition being actually the best path out? Like, how do you handle those tricky moments in light of the fact that this is going to reflect on the reputation broadly amongst a pretty small community of founders?
Exactly. I think we do have company that we have to make the difficult decision. For example, we do have company in the past that after 2 or 3 years, the revenue is not picking up. Yeah. It's hard to pivot. The market, they're focusing on low margin. So we are on the board. So talking with the founder, really, we're not forcing founder to make a decision. We just share all this data analysis and also providing introduction. Do you want to give a try? Talk to this potential buyer, see what you can get from this instead of waiting until you run out of capital. And the founder took the suggestion, eventually sold the company, got 3x of principal back to everyone. And there's also founder they don't want to sell. And they don't want to sell, they continue to grow business. We respect that. And if we really have to exit, we'll probably find a way, for example, through secondary as needed.
Yeah.
We haven't done so in the past, but this is our year turn, so which means it's a fund 1 is a 10-year fund. So we may consider doing so on that, but I think essentially it's more important is mutual respect. But eventually, we want to be objective on sharing information, what is the best decision for the company.
Yeah.
I think the benefit part of us as early stage investor is we came in so early. So our interests are fully aligned with the founder. We got good exit, they got good exit. If we got a crappy exit, it's also not looking good for founder.
Right.
So it's on metrics game.
Yeah. How do you feel about secondaries overall? It's like a big topic around Silicon Valley these days.
Oh, yeah. So we're not very experienced with secondary because, as I said, we didn't really do that in the past. We only did one deal last year. That's a special case. And also it's a secondary to a new investor. It's a semi-unicorn company already. And founder didn't plan to exit in the next couple of years.
That's right.
But other than that, we didn't really have lots of experience dealing with the secondary platform. But I think in the past couple of years, one key questions LP been asking is liquidity.
Sure.
And the IPO market, this year, consider what is happening in the public market is still not clear what they're going to fully open up. So I think
not clear is saying the least of it. Yeah.
Yes. So I think secondary definitely provide a very nice channel for both LPGP to create some early liquidity.
Yep.
I think for us, we do have the benefit. We came in so early with valuation like lower than $10 million, $8 million. We had lots of exit already in the past couple of years through merge acquisition.
Right.
Couple $100 million merge acquisition, smaller size, bigger size. This is not a type of M&A going to return the whole fund, but it will be the nice M&A to return some principal and even all the principal back to LP, which also give us more flexibility. Yes.
Do you have a strong viewpoint on recycling that capital or actually providing some distributions a little bit early?
I think it depends on the size of the exit. But for us, we've been always doing the distribution back to LP because it's still sizable. But if it's a very small exit, I think fund manager should consider recycle it.
Yeah. Do you typically have a strategy where you're going to follow on in the next couple rounds after that initial investment? So that could be then reserved for the next follow-on as well, I guess.
We kind of structure the fund from the beginning. It's not only one check.
Yeah.
We want to be long-term partner with the founder. So what we do is we target 25 to 30 company per fund. That's an initial check.
Yep.
First check is seed Series A. Then we reserve capital for another 2 rounds of the follow-on.
Wow. Okay.
Yeah. But of course, not for every single company, but for the company doing great. So for our fund structure, roughly 50% of capital already reserved for pro rata when we're raising the capital.
And are you almost always on the board? Do you lead check in most of those early stage rounds?
Starting from fund 2.
Okay.
Fund 1 were very little. That's when I started in 2015 as a solo GP with a small check, like less than $500,000 check.
Right.
Now with our fund 4 is a $190 million fund where we actually are taking more board seats. I will say starting fund 2 were like 30-40% board seats.
Yeah.
Fund 3, fund 4 is like 50-60% board seats.
Yeah, I saw it. Congratulations on the fundraise, by the way.
Thank you.
What's the biggest, I hear from emerging managers all the time, or I guess I hear 2 things. One is, I'm going to be a solo GP and I'm very excited to never hire anyone, right? Like I really love this solo GP lifestyle. And the others are probably trying to emulate you and grow the firm alongside the fund sizes as they expand. What's the biggest difference from you for the solo GP life versus where you are now managing a team of 10, 15?
Yeah, now we have 12 full-time and also 5, 6 part-time. Yes, I think a solo GP provide lots of the flexibility. And another thing is a solo GP be able to just stick with the initial mandate for a long time. But the challenge is, the bandwidth. And another thing for me to consider at the beginning is what is the long-term vision for a fusion fund while I'm launching this company.
Right.
I'm an entrepreneur, so I always have an entrepreneur mindset to do any company, including fusion fund. I want to build up the best firm.
Okay.
And in order to build that best firm, you want to have a best team. I always say that there are no perfect individual, there are perfect team. But how to assembling the team together with same vision and also like a very good alignment, but meanwhile comprehensive industry background and complementary to each other. Then in terms of skill set, that's kind of the general guideline for me to continue build up each fund. And we want to be able to, another thing is, one thing is the long-term vision of the fund. What we want to do, the sector we want to cover, and also size. Another thing is we want to do better and more for founder.
Sure.
Yeah. One person, I can do a lot of things for founder, but I'm only have 24 hours a day.
Right.
I also have a limitation of my knowledge and the network, but building up the team will be able to support a founder from the beginning even to the end. Now when founder getting more acquisition offers, thinking about IPO, we also have strong domain expertise in the team to help them optimize the exit. When they're doing different type of partnership across the stage, we could also serve on the board, giving different network and support. So that's the thing we want to build up.
Does each GP at Fusion Fund then have a different mandate in terms of the sectors that they cover, et cetera, or is it kind of a mix and you kind of cross sector borders?
Yeah, so our structure is more like a pyramid. I'm the only managing partner, so I cover all 3. And then I have 3 partners, each of them cover one vertical.
Gotcha.
So we have a sector-focused partner, investment partner, and I cover all 3. Meanwhile, I also probably make the decision on the allocation. And although we have 3 vertical, doesn't mean we have to do 1/3 every single year. It depends on market opportunity. Another thing is the price.
Yeah. How do you evaluate? So you must then come into those decisions with some sense of what you consider the white space within those areas, right? Like where do I think the next marginal dollar is going to actually make the most use?
Yeah. We conduct lots of industry research report. By the way, we recently published the AI in healthcare report and physical AI report. Thank you. Physical AI report is the same week of a media GTC. So we do that every quarter. That's our approach you saw the content. The public version is actually the short summary. Internal version is even 40-50 pages long.
Okay. I'd love to read that one if you want to send it to me.
Happy to share. Okay. Yeah, we really go deep in terms of technology landscape. What the tech is ready for commercialization. Another side is, okay, tech is ready. How about your customer? Are they ready to integrate technology? Are they willing to pay? How much is the budget? What is a key player? Because besides tech and the buyer, there are also other players under the table you want to consider. So this is one part of us consolidate all the knowledge we have across the network we build up to a learning, then we could help us make better decision. And for me individually, you mentioned that I went to Davos, I went to all this different type of conference, not only just a tech-focused gathering, but also beyond tech. Unfortunately, we're not in the Silicon Valley kind of small bubble
Right.
in the past that you only care about tech. You
Right.
need to think about geopolitical issue, microeconomy issue in order to make the judgment call what's going to happen in the next 1 year or 2 years.
Yeah.
And because the market is changing very fast. Long-term 10-year, we know this technology going to take off, this sector going to take off. But in the next 1 or 2 years, what is the better timing?
Right.
Putting capital, what is going up and down, and whether the ROI makes sense. Buy low, sell high is always the case for any investment, and we want to also be able to make the judgment call on that.
Do you have a strong sense from the CXOs that you're talking about in the network that you've built, whether clearly, or at least what we're told from the outside, is that we're all adopting AI as quickly as we can, but are there specific segments of these businesses that are more or less excited about that, or are there some that are still pretty reticent to like trust younger startups with those kinds of workflows?
I think compared with a couple of years ago, we see even very traditional like insurance, financial, highly regulated industry, logistics, supply chain. Now with anti-globalization actually bring lots of opportunity for supply chain. Used to be global supply chain, now it's a regional supply chain. That's all the opportunity. Yes, it's challenge for existing market, but that's opportunity for smaller startup. So I think large corporate are more eager and open to try out a new solution. What we heard is the budget is increasing, and also the sales cycle is getting shorter and shorter. But on the other side, there's still sometimes I would say a gap between Silicon Valley and the rest of the industry in terms of what really matters the most. For example, I heard from a major financial institute that they're trying some AI solution and there's a data leakage. And the first reaction is we're going to pause all the AI integration until we figure out how to protect the data. So I think for certain industry, yes, efficiency improvement is important, but it's built on top of I need to make sure compliance is okay, security is okay. Why we talk about the future of AI is AI on the edge devices. Because for certain industry, it's not only about they don't have infrastructure to upload everything to the cloud, also because they don't want to. Why to upload everything to the cloud? It's so sensitive and also dangerous. I want to have this local device like this microphone be able to process what I'm talking about with AI run on top of it. AI on the edge provide better security, better control over the data. And also AI on the edge requires small vertical model. So large model, does it really work? Not only cost-based, but also privacy. So all of this thing matters more than the AI model itself when the large corporate looking at solutions. So that's the part we wanted to build up the bridge to make sure founder understand it. Our founder knows how to deal with it, be able to work with large corporate. Give you an example, we have a company using AI to automate commercial paper issuing. Most of people even didn't know what is commercial paper issue. It's a huge multi-billion volume happening every other week in the Fortune 500, and they done by manually in the past, and they were able to use AI to get it automated. But the first layer the problem need to solve is make sure compliance is all checked.
Absolutely. What else do Silicon Valley entrepreneurs tend to overlook when they're trying to enter, the world of commercial partnerships or bigger businesses?
Another thing very simple is the cost of the technology.
ROI.
What
do you mean?
AI need to be affordable. I've been talking about it since 2 years ago. AI need to be affordable. Basically, we could break down to a couple pieces. Number one, access to high quality data. Because if we only rely on large model, then you need to train over tons of tokens and data. The cost is way too high. It's not sustainable at all. It's not only the cost of the GPU, it's the cost of the energy. We don't have enough energy to support it. So how to access to high quality data, be able to use high quality data, train a small vertical model, make model itself cheaper. I think that's kind of the number one thing in terms of the deciding on the price. And then fine-tuning model is actually a very complicated process. How to have the right domain knowledge to fine-tune, domain knowledge to giving feedback, also make the process cheaper. And the last piece is architecture, choosing the right architect of the AI infrastructure to reduce energy consumption, GPU consumption, enable edge capability and data privacy. That will also reduce the cost. Eventually, it's not only about the cost you're selling to the customer. You can sell without the profit to start, but eventually you want to have a profit margin.
That would be good.
And if you have profit margin, things can grow very fast. We have at least, I think, 2/3 of the company we invest in the past 2 years have 20x revenue grow in the past 1 year.
Wow.
And the two company, one grow from $0 to $20 million is AI infrastructure company. Another is AI infra plus AI application. Revenue grow from $500,000 Q1 last year. Now it's $150 million.
Oh, wow. So do you think that revenue is sustainable? You mentioned the CXOs are they have experimental budget and maybe that budget is expanding. But the big question that everyone seems to be asking is, we see the growth rates. Are those growth rates sustainable and reliable? You're you think that yes, for the most cases?
Yes, I think it depends on the architecture.
Sure.
That we look at, okay, your margin is high, 70%, 80%, no problem. And you only have a team, the company making $20 million ARR, their team is less than 10 people.
Right.
Yeah.
Are most of your companies smaller than they used to be?
Oh, yeah, that's another thing. We also have a company recently announcing over $100 million ARR. Last time they raised a round was 2021.
Wow.
Yeah,
Yes.
the company name is Otter AI. I think lots of people use it.
I'm totally familiar with it. Yes, that's amazing. Do you think that is the small team sizes? I completely understand why it's useful for founders, right? You're keeping your burn lower. You're probably improving your decision-making speed if the total connections between the business is smaller. Are there any downsides of a small team?
Yeah, smaller team, I think another thing for B2B is, okay, initially you need to get to the customer, but later you need to be able to support customer with customer success.
Correct. Yes.
And that's when still go back to a traditional corporate style, how to build out that team.
Yep.
And another thing is, okay, you got a great success in the initial product offering, how to expand beyond that to do upsell, offer a different feature, trying different thing. That's when not only you need customer success, you need application engineer to talk with customer, understanding the feature,
Right.
come back, build on top of existing platform. So I think the team size in general will be smaller, but doesn't mean you can just stay as 10 people team forever. You still need to expand. But the upside is there are so many different ways to do it. You could leverage third party, you can leverage partnership. Another thing we also found that we have a couple companies, including one based in San Francisco, they leverage open source community. They launched something in open source community. It's open source project. Everyone use it for free.
Yep.
And they get tons of supporter. And then they launch another one called the Pro version, which is for enterprise use cases. So developer who love it,
Right.
want the company to use it, they automatically become an ambassador. It's kind of a Lululemon
Right.
model for enterprise company.
Build
leverage
these supporters and
community,
believers.
Exactly.
Yeah.
And the early ambassador. And they know company technology very well because start from open source, they know the technology inside out.
Yep.
They also can giving feedback, okay, how to build on top of this open source to make it professional level.
Totally.
So we have a couple company get pretty successful traction because of the open source.
Yeah, you mentioned a little while back about the sector theses, and I'm just wondering, in this age where we're talking about CXO budgets, et cetera, you published a report recently on AI healthcare, and the opportunity and some of the challenges there. The first challenge being data, the second one being regulation in general. What's your general advice for a founder who's thinking about approaching maybe a more heavily regulated industry with this AI solution? Should they be, or what are some common mistakes that you see founders make as they go into those kind of fields?
Yeah, I think one thing is a founder just to stay away from highly regulated industries by thinking that it was really hard to handle, it's so complicated. But think from a different perspective that all this highly regulated industry, they've been doing regulation for more than a decade.
Right.
The regulation was focusing on data.
Yep.
And now we're still debating whether the regulation for this new AI technology should be on technology or data. For them, that's a pretty mature thing.
Yeah.
And so now it just need to understand with AI as a tool how to handle this new regulation surrounding the data, but data is still the same data.
Right.
So the education process might be faster than founders' imagination. Another thing is there are lots of new technology potential to enable this compliance regulation requirement. AI on the edge devices is one thing I mentioned.
Sure.
And also we have companies doing federal learning. Federal learning be able to handle, for example, your hospital or financial institute. If you want to monetize your data, I'll share with third party, run the federal learning on top of your data. Third party can use it without you need to move out, transfer your data. That kind of still keep the data within the existing compliance and regulation framework.
Right.
And the AI company can directly work with them.
Right.
So there's lots of a smart way without doing a lot of change on the product to make it work.
Yep.
But it definitely requires knowledge of understanding the framework of this highly regulated industry and be able to take it from there. So I think for lots of industry, including healthcare, we mentioned, including insurance and the financial industry, they're very eager to integrate AI. They also are very cautious on the compliance risk because essentially
They have to be.
nobody wants to lose their job.
Totally.
And this is the different.
Yep.
But if you're able to just work within their existing framework and the workflow and solve their worry, it's easy to go. Their integration could be much, much faster. One of the major bank on board one of our company, they're doing Kubernetes integration. This company only Series A round. This major bank gave a very big contract already.
Wow.
Yeah, team is less than 10 people.
Do you see a big difference between the heavily regulated industries if you were to rank healthcare and finance and some of the other ones in terms of openness to AI? Is there a big ranking in your head? Or are they all kind of equally excited about it?
I would say healthcare is very complicated because healthcare have a device, have a life science, have a pharma. So different vertical have different openness. But I think healthcare is getting much better in the past 2 years. So another thing is regulation. Another thing is we recently Becker company, actually technology is from this Evo2, recently announced by Arc Institute.
Okay.
It's kind of like small ChatGPT moment for foundation model for DNA sequencing data.
Cool.
Yeah. So I think all of this momentum, also including AlphaFold, everything is making the healthcare system more open. Because one thing about healthcare industry is it's not only 20% US GDP. You know, for all the human society data, more than 30% are related to healthcare.
Wow. Yep.
We only utilize less than 5% of it so far.
Yeah.
And so not only like AI, healthcare need AI also need healthcare, kind of supporting each other. So it's getting better. Financial industry is getting much better right now. I think lots of the large banks also are thinking about competition from each other and also thinking about how to supercharge existing workflow and the margin concern, especially for insurance company, they want to improve their margin.
Sure.
You'll be surprised how active they're adopting AI solution.
Yeah.
And lots of merge acquisition is happening within insurance industry as well.
Interesting.
Many insurance companies, they're now public listed company.
Right.
So the deal is like private company, but it's over $1 billion.
Right. Are you seeing a lot of M&A in other parts of your portfolios?
Oh yeah, we got a couple M&A. We had a company we invested last year, September, October, got acquired this year by $220 million.
Love it.
That's actually Fund 4 company.
Great.
Yeah, because we did Fund 4. I haven't got a chance to talk about Fund 4. We started raising last year summer and we got oversubscribed in December. So within half a year, we not only finished, but oversubscribed heavily. So we've been deploying capital after first close.
Right.
And we're doing, we just did an announcement in March. We actually did the final close in January.
Yep.
But this company was sold in January. So they did announcement in February, even before we're announcing our Fund 4. That's how fast it is.
Some immediate metrics for you off that. I love it.
It's a good multiple. It's good IRR. And also for some of Fund 3 company, we got recently 2 exit.
Amazing.
It's not big size. It's all like range from like $300 million, $500 million range, but it's still nice in terms of liquidity.
That's healthy for sure. I actually wanted to talk to you about Fund 4, as you mentioned, oversubscribed in a short period of time. When you think about expanding the fund size, and this obviously not all managers have the opportunity to think about that, but you were originally shooting for, say, I think 150 and you went to 190 or so. What does that extra 40 million get you? Do you just do it because you want to have those great relationships with the LPs that you're building, or does it fundamentally change your strategy at that level?
Yeah, so when we initial planning for the fundraising, our target was 150, but we did put a hard cap. We don't want to raise more than 200 mil.
Okay.
So actually by December, our commitment is already almost approaching 250.
Right.
So we have to we actually did the final close earlier than our original plan in order to now to continue getting commitment and be able to balance out the allocation. So the reason we eventually close on 190, that's also go back to we want to be disciplined on the valuation and also the fund size.
Yep.
Getting extra capital is nice because then we have more reserve for pro rata. And we target 25 to 30 company with this extra $40 million. Maybe we'll go more towards to 30 company total for Fund 4.
Yep.
But still within the range that we don't need to start to have pressure of allocating capital.
Right.
That's the reason we had everyone told me in December that, that's a good problem to have. You're negotiating with LP cutting off allocation.
Right.
It's actually very difficult, the negotiation.
I bet.
Yeah. I was actually in Antarctica in the last week of December.
Having calls with LPs from Antarctica? Okay.
And thanks to technology, I got a Starlink to be able to call into all the Zoom meetings.
Sure.
While chasing penguins and orca.
How was the reception?
It was really good.
Yeah.
And some LP were impressed. They're like, why cutting allocation? By the way, where are you? I'm like, I'm in Antarctica. They're like, thank you for making this
great
possible.
Zoom background as penguins hop around behind you on the ice floes.
Yeah,
That's
so
amazing.
it was a very interesting December. Also, we got an exit happen in December.
Right.
The deal closed within 3 weeks, which is also quite impressive. Go back to what you asked early on about M&A. Right now, we see so many companies getting merger acquisition offer. Of course, some founders choose to engage, some founders choose to turn down the offer, convert it to partnership, I'll move forward. But we're definitely are seeing super active M&A market right now. All the strategic buyer, not only tech company,
right,
but just in general, lots of companies are paying a premium price, try to buy the company to quickly do the integration.
Totally.
So sometimes M&A might be better exit than IPO. Look at the Google deal with Wiz.
Absolutely.
$32 billion.
Right.
Not bad.
And certainly at a much faster timeline most of the time.
Of course.
Yeah. Is there, when you're talking to these LPs for Fund 4, I'm assuming the mix of LPs has shifted pretty radically since Fund 1.
Yeah.
How do you think about, building relationships with new LPs that might be in Fund 5 or Fund 6 or, for the rest of the lifetime for Fusion?
Yeah. You're so right. Our Fund 1, Fund 2 LP, most are family offices.
Right.
And starting from Fund 3, that's we intentionally want to diversify LP base and go to talk to institutional. We want to institutionalize the fund, also institutionalize the LP base.
Yep.
So Fund 3, we have roughly 40% institutional, most are founder fund. But for Fund 4 right now, we actually have 70% are institutional.
Okay.
We basically, I was joking, we're checklist all different categories: sovereign wealth fund, endowment, pension foundation, insurance company, bank, and
The whole pyramid.
Yeah, the whole pyramid.
Yeah.
And then we have 30% of family office, including some family office, been supporting us from the beginning. I think this diverse background LP is really, really valuable to us. Not only just the interaction with them, hearing the feedback about they see so many fund manager.
Sure.
Another thing is they're not only investing in VC. They're investing across different categories, PE, buyout, public market.
Sure.
All this information gathering is so valuable for us to make our judgment call on the market timing. And some of the information we could even carry over to share with the founder. So I think we also kind of use the mindset of building up community when we are choosing the right LP to work with.
Yeah.
And so we actually have pretty close engagement with the LP, even institutional LP, to share information with each other. And to continue from there, of course, we're going to continue build up the relationship with the institutional LP we have. And the good thing is, we never had anchor LP. And I said nobody invests more than 20% of the total fund size. Still true for Fund 4. So based on that, which also means my existing LP, they could do much bigger check sizes.
Right.
When we continue to grow, then they will be able to build up a long-term relationship.
Right.
Another thing I do want to highlight is we kind of represent emerging manager. Really go through Fund 1 to 3 now to Fund 4. I sometimes joke with my team. I'm like, feel like a high school graduate. Not teenager anymore,
right.
But still young, ready for college. Okay. So new challenge.
Between the summer between high school and college.
Kind of.
Yeah.
So what we found is lots of large institutional LP, they start to actually show very strong interest to emerging manager. They tell me the metrics that emerging manager, smaller size fund, early stage focused VC are top performing VC.
Right.
And show me the comparison, the number. And also they start to have a more in-depth understanding of how to partner and work with early stage venture. They're willing to actually lower their check size, invest in smaller check to build up long-term relationship.
Where's the check minimum there for an institution generally?
I think institution generally 20, for us it would be like a 20 to 35. Some can go low to 10, but in general will be like 15, 20 to like 35 to 40 range.
But you see that there is an increased level of interest in emerging managers from that set of portfolio LPs.
This is the type of LP used to invest in check size at $50 million minimum, and now they're willing to spend even smaller check.
Why do you think that is?
I think they want to back the next generation leader. They also wanted to be able to invest in the future. It's kind of similar mindset I was investing in early stage founder.
Right.
And yes, they're small. They're not taking bigger checks, same as us. But we have potential to continue grow. And there's so many other fund manager, emerging fund manager, already going through this critical, Fund 1, 2, 3 phase now is going to the more established and mature stage, like going to college.
Right.
Yeah.
Do you think that there is a really big unlock from, say, Fund 2 to Fund 3 or Fund 3 to Fund 4 in terms of just the level of institution that is willing to look at you because you now have a track record of 3 funds, whereas before they're like, come and talk to us in 5 years?
Yeah, I think track record definitely play an important role.
Sure.
We have some nice, performance number, DPI, everything matters. But I think also is we have a pretty consistent methodology of how we want to allocate capital and the sector focus.
Yeah.
I think that's the thing showcase that although we're emerging fund manager, we're aiming for the long term.
Yep.
We also have a bigger vision that what we're doing right now going to pave the way for a bigger potential rapid growth in the future.
Right.
I think, yes, sometimes we read institutional LP are looking for something more predictable. But thinking about predictable also means that, you have consistency.
Yep.
Methodology. Instead of, okay, this fund is I'm getting luck, I'm doing this. The other fund, okay, I'm jumping out from the deep tech, I'm doing crypto.
Right.
That's something unpredictable.
Right.
It might be harder for institutional LP, but in order for a fund to continue to grow to a major impact, a top tier VC, I think have the consistent methodology is important.
Did you do what you said you were going to do? This is the thing that we hear all the time.
Exactly.
Many different ways. Is there a metric or a quantitative thing that these LPs are looking for that is not the typical funds, IRR, TVPI, blah, blah, blah? Is there something where that stands out in your pitch to them, either a number or an approach, perhaps, that they say, oh, that really does set you apart?
I think one thing, I don't know whether it's really the critical metrics they're looking for, but many of the institutional LP we talk to, they ask for the list of a company revenue growth. We proactively provide that in our data room with a list of the company, how much revenue grew in the past 1 year or 2 years.
Right.
And some of them also active asking, oh, do you have an updated number? They want to look at understanding the nature of the revenue.
Gotcha.
I think that's another number. You can tell that when I mentioned about portfolio, you already hear me talk about this company valuation, how much. I always mention this company revenue. 20, 100 million, $2.5 billion, because that's the solid metrics we believe in.
Yeah.
We're very glad to see that LP also share the same judgment call, and that they want to look at the number too.
Yeah, the portfolio level KPIs are becoming far more important. I think not even just for, a growing institutional manager like yourself or emerging manager, but at the fund 1 and fund 2 levels as well.
Yeah.
The more confidence you can give your LPs by showing them what is actually happening underneath your fund level, I think is really, really crucial. Yeah. And especially, and I don't know if you hear this as well, one of the feedback points that we've heard from LPs around emerging managers in particular is there's been a lot of challenging conversations they've had to have with them over the past couple of years where they may be holding a company at a mark that is very different from where the rest of the funds are holding that company. And they, they talk all the time. LPs are conversing and saying, hey, how are different funds holding the same asset?
Yeah.
And if you are wildly optimistic about that asset, that is probably going to provoke a conversation.
Yeah, I think sometimes, we will see some company when they're raising money, maybe the revenue is not there, the valuation is much higher, premier price. Makes sense. It happens all the time.
Right.
But if after that run happening within 1 or 2 years, the revenue is now catching up with the valuation, that's the issue. That's when I think as a fund manager, as a market, need to really reevaluate what is the value of the company.
Yep.
Essentially, valuation is being given
Yep.
by investor, but revenue is a solid validation from the market.
Yes. Well said. Do you have a trouble? How is your, one of the things I had Charles Hudson on the podcast a little while ago, and he was talking about how in his investments at pre-seed and seed, typically, he had all this wonderful roster of co-investors. And then over the last 3 years, it's kind of felt like he has to go and find a whole new set of co-investors. Have you found that to also be a problem, or are you still like co-investing alongside many of the same people as you used to?
Yeah, I think we have we are not only sharing deal with a certain firm, but we actually have a page of who we invest with. It's a pretty big map.
Yep.
Yeah, but pretty good consistency.
Yeah.
Of course, different vertical have a different type of firm. Yeah, so I think lots of our co-investors are also this type of long-term investor. We actually have lots of co-investors, larger size firm, and we co-did a deal with a firm like 8VC. We co-invest in deal with ParaVC, with Charles River. So I think they are very passionate about early stage.
Yeah.
But meanwhile, they have a much bigger size fund and also lots of dry powder for pro rata.
Sure.
So be able to kind of collaborate closely.
Love that. Yeah. Okay, I'd love to end these podcasts with like 3 or 4 rapid fire questions.
Yeah, please.
Okay, first rapid fire question. What is the sector you're most excited about right now?
AI in healthcare and also space tech.
Those are 2 very different sectors. Why those? What's like the one log line that makes you so excited about it?
AI in healthcare is a sector, big market opportunity, and also it's a perfect vertical that combine doing the right thing in a smart way that we're helping people and get great financial return. Space tech is in the phase 2 right now. I think we're a younger generation. Our next 5 to 10 years is going to be very different by opening up an extremely lower cost of the launching and also satellite.
Yep.
With access to satellite data, there will be space economy. Think about all the AI application you're building on the Earth. You can potentially build it on the space, and all the infrastructure opportunity utilize of the satellite data is truly amazing.
Yeah. You need more sci-fi in our lives. I love that.
Yeah. And this may happen in the next 3 to 5 years.
I love it.
We have a company called Starpass. They're doing the robotics system for the Moon Foundation.
Cool.
It's kind of gas station for the space traveling.
Gas
Ready
station
to
on the
go.
moon. I love
yes, ready to go.
that. What is your opinion on the debate about whether founders should be in Silicon Valley?
We have actually roughly half, 60% are Silicon Valley, 40% outside. I think it's important founder build up connection to Silicon Valley.
Okay.
Because here is the most concentrated capital and the business and also exit. Merger acquisition is very active here. But in terms of cost of living, everything, not necessary. So we have lots of founders, although they're outside Silicon Valley, they come to visit quite often. They have 1 or 2 people based here.
Okay.
And we also support our founder be able to even build up team. For example, their engineering team is in UK, is in Canada.
Sure.
Be able to lower the cost.
Right.
Yeah.
So you don't need to live here, but you should touch the ecosystem.
Exactly. You have a good investor on your board, maintain very strong connection within Silicon Valley to help you, like us. Come to talk to us.
Exactly. Talk to PG Fund for sure. Okay, last question. What is an example of something that you've done for a founder or that Fusion Fund has done for a founder that's beyond capital? So like a unique way that you've sort of tried to provide support or help to a founder?
Yeah. So beyond capital, I think there's lots of things we do for them. Beyond capital, resources on the connection and also talent, finding the right independent board member, even sometimes just helping founder with some early liquidity to help them live a better life.
Totally.
Because I understand how miserable life could be. I have a founder, have 2 boys, and he's the only one working, and he's paying himself very little.
Yeah.
So we're talking about, okay, you have a successful Series B round, so maybe generating some liquidity for yourself, and then you don't need to bother with your, pressure from the life demand. And also another company founder have a group of PhD try to think about how to afford a house in Silicon Valley, which is insane.
Tough.
So I also help them set it up like remote team. Then other key employees are very happy getting a house back in 2019 in Austin.
Yes. Oh man, the rental market is maybe a whole other podcast that we can talk about here. But it's Lu, this has been fantastic. Thank you so much for coming in. I really enjoyed our conversation.
Yeah, thank you for having me. Look forward to next one.
Absolutely. We'll do it again soon.
Yeah, thank you.
Cool.